Financial markets, platforms for buying and selling financial instruments. What are financial markets? In simple terms, financial markets are platforms where financial instruments are bought and sold. Businesses care about financial markets because they can raise capital, manage risks, and invest surplus cash. To ensure fair and efficient markets and protect investors and consumers, regulatory policies are in place. These policies promote trust, stability, and integrity in the financial system, benefiting businesses and the overall economy. Why capital markets matter to businesses? Capital markets, long-term financial needs. Capital markets are a segment of the financial market that deals with long-term financing and investment. They provide a platform for raising funds for businesses and governments to meet their capital needs for extended periods. Capital markets facilitate the buying and selling of long-term financial instruments like stocks and bonds. Primary markets. The primary market is where new securities are issued and sold to the public for the first time. Companies and governments raise fresh capital by issuing stocks through initial public offerings, IPOs, or by selling bonds to investors. In the primary market, businesses directly interact with investors to obtain funding. Importance of primary markets. Importance of primary markets. Capital raising. Primary markets play a crucial role in helping businesses and governments raise new capital to finance their expansion, projects, or infrastructure development. Investment opportunities. Primary markets offer investors the chance to buy newly issued securities at the initial offering price, providing opportunities for potential capital appreciation and long-term investment growth. Economic growth. By providing a means for companies and governments to raise capital, primary markets contribute to economic growth, job creation, and infrastructure development. Benefits of secondary markets. The secondary market is where previously issued securities are bought and sold among investors. It is a marketplace where investors trade stocks, bonds, and other financial instruments that have already been issued in the primary market. The transactions in the secondary market do not directly involve the issuing company or government. Importance of secondary markets. Liquidity. Secondary markets provide liquidity to investors, allowing them to buy or sell securities at any time. This enhances the attractiveness of long-term investments by providing an exit option if needed. Price discovery. The continuous trading in the secondary market determines the market price of securities, reflecting the collective perception of the company's or government's performance and future prospects. Secondary markets. Efficient capital allocation. Secondary markets facilitate the flow of capital to where it is most needed. Investors can buy and sell securities based on their expectations, and companies' stock prices reflect market sentiment and valuation. Investor confidence. A well-functioning secondary market instills confidence in investors, knowing they can readily sell their investments if required. This, in turn, supports the primary market as investors are more willing to participate in initial public offerings. In simple terms, capital markets address long-term financial needs. The primary market is where new securities are issued and sold to investors for the first time, providing companies and governments with fresh capital. The secondary market is where already issued securities are traded among investors, offering liquidity and price discovery. Both primary and secondary markets are crucial for economic growth, efficient allocation of capital, and investor confidence. Financial markets. Understanding the role of capital and money markets in the financial system. Introduction to financial market environment. Financial market environment. The financial market environment refers to the overall system where various financial instruments are bought and sold, allowing individuals, businesses, and governments to raise capital, invest, and manage financial risk. It plays a crucial role in facilitating the flow of funds between those who have excess capital investors and those who need capital borrowers. The financial market environment consists of different markets, such as capital markets and money markets, each serving distinct financial needs. Capital markets. Long-term financial needs. Long-term financial needs. Capital markets are where long-term financial instruments are traded. These markets are essential for raising long-term funds, typically for periods exceeding 1 year. They enable businesses and governments to fund major projects, expand operations, and meet long-term financial obligations. Investors in capital markets are generally seeking to invest for extended periods and earn returns through dividends, interest, or capital gains. Example of capital markets, primary markets. Primary markets. In the primary market, newly issued securities, such as stocks and bonds, are sold directly by issuers to investors. Companies or governments use the primary market to raise capital for the first time by issuing initial public offerings, IPOs, or issuing new debt. The primary market is crucial because it provides an opportunity for companies to raise funds for growth and expansion, which in turn contributes to economic development. Example of capital markets. Secondary markets. The secondary market is where existing securities previously issued in the primary market are bought and sold between investors. In this market, investors trade securities with each other, and the proceeds from these trades go to the selling investors, not the issuing company. Secondary markets are vital as they provide liquidity to investors, allowing them to buy or sell their investments without requiring the involvement of the original issuer. This liquidity enhances investor confidence, making the primary market more attractive to potential issuers. Money markets, short-term financial needs. Short-term financial needs. Money markets are designed to meet short-term financial needs, usually for periods of 1 year or less. Participants in money markets are typically seeking low-risk investment opportunities for their excess funds. These markets play a crucial role in facilitating short-term borrowing and lending, ensuring smooth cash flow management for financial institutions, corporations, and governments. Importance: capital formation, money markets, short-term financial needs. Money markets are designed to meet short-term financial needs, usually for periods of 1 year or less. Participants in money markets are typically seeking low-risk investment opportunities for their excess funds. These markets play a crucial role in facilitating short-term borrowing and lending, ensuring smooth cash flow management for financial institutions, corporations, and governments. Overall importance: the capital and money markets are essential components of the financial system for several reasons. Importance: efficient allocation of capital. Capital formation. Capital markets facilitate the flow of capital from investors to companies and governments, enabling them to finance projects and investments that contribute to economic growth and job creation. Efficient allocation of capital. By providing a platform for buying and selling securities, capital markets ensure that capital is allocated to its most productive uses. This helps direct funds to companies with the most promising prospects, fostering innovation and competitiveness. Importance: liquidity in capital markets. Liquidity. The presence of secondary markets in the capital market ensures liquidity for investors. It allows them to convert their investments into cash quickly, which increases confidence in long-term investments. Importance: risk management. Risk management. Investors use capital markets to diversify their portfolios, reducing risk by investing in a variety of securities with varying degrees of risk and return potential. Economic indicators. The performance of capital markets is often seen as a reflection of the overall health of the economy. Bull markets and bear markets can signal economic trends and investor sentiment. Financial markets. Financial markets are platforms where buyers and sellers trade financial instruments such as stocks, bonds, currencies, commodities, and derivatives. These markets facilitate the flow of capital and enable businesses, governments, and individuals to raise funds, invest, manage risks, and conduct various financial activities. Why do we care about financial markets from a business perspective? Capital raising. Capital raising. Businesses can raise capital by issuing stocks or bonds to investors in the financial markets. This funding allows companies to expand operations, invest in research and development, or undertake new projects. Investment opportunities. Investment opportunities. Financial markets provide businesses with opportunities to invest surplus cash and generate potential returns. Companies can diversify their investments to optimize their financial performance. Risk management. Risk management. Financial markets offer various financial instruments that businesses can use to manage risks, such as currency fluctuations or interest rate changes. Hedging strategies can protect businesses from adverse market movements. Access to liquidity and benchmarking. Access to liquidity. Publicly traded companies can offer their shares to a wide range of investors, providing liquidity to shareholders who may want to buy or sell their shares in the financial markets. Benchmarking. Financial markets serve as a benchmark for companies' critical regulatory policies in the U.S. Financial System Securities and Exchange Commission (SEC). The SEC is the primary regulatory agency overseeing the U.S. securities industry. Its goals include protecting investors, maintaining fair and efficient markets, and ensuring accurate and timely information from companies. Federal Reserve, the Fed. The Fed is the central banking system of the United States. It plays a crucial role in monetary policy, controlling the money supply, interest rates, and overall economic stability. Federal Deposit Insurance Corporation (FDIC). It provides confidence to depositors that their funds are protected, even in the event of a bank failure. The FDIC insures deposits in banks and savings institutions. Commodity Futures Trading Commission (CFTC). The CFTC regulates the commodity futures and options markets. Its responsibilities include ensuring fair practices and preventing fraud or manipulation. Financial Industry Regulatory Authority (FINRA). It promotes fair and ethical practices in the securities industry. FINRA is a self-regulatory organization that oversees brokerage firms and brokers. Importance of regulatory policies. Investor protection. Regulatory agencies protect investors from fraudulent activities and ensure access to accurate information. Market integrity. Regulations maintain fair and efficient financial markets, preventing manipulation and promoting competition. Financial stability. Regulatory policies enhance the stability of the financial system, reducing the risk of crisis and supporting economic growth. Confidence and trust. Clear regulations foster confidence and trust among investors, businesses, and the public. Consumer safeguarding. Regulatory oversight protects consumers from deceptive practices and promotes financial literacy. Financial market environment, primary market. Financial market environment. In the financial market environment, various markets facilitate the buying and selling of financial instruments to meet the diverse needs of participants. The primary market and the secondary market are two essential components of this environment. Primary market. Corporation. In the primary market, corporations are the issuers of financial instruments, such as stocks or bonds. They seek to raise capital by offering these instruments to the public or institutional investors. Corporations use the funds they raise from the primary market to grow their business, finance new projects, expand operations, or meet other long-term financial needs. Importance of the primary market. The primary market is essential because it allows corporations to raise the initial capital they need for their operations and expansion. By issuing stocks or bonds, companies can access funds from the public and investors, which they can use to fuel growth and finance their long-term projects. The involvement of intermediaries, such as investment banks, streamlines the process, making it easier for corporations to bring their securities to the market successfully. Example to support the keynotes. Let's take the example of a tech startup, Innovate Tech Incorporated, which has developed a groundbreaking software product and is looking to expand its operations. To raise capital for growth, Innovate Tech Incorporated decides to issue shares of its company in the primary market through an initial public offering (IPO). An investment bank is engaged as an intermediary to help Innovate Tech Incorporated in the IPO process. The investment bank (IPO). The investment bank advises Innovate Tech Incorporated on various matters related to the offering, such as determining the number of shares to issue, setting the IPO price, and handling the legal and regulatory requirements. The bank also markets the IPO to potential investors, including individual investors and institutional funds. During the IPO in the primary market, primary investors, which can be individuals or institutions, purchase shares of Innovatech Incorporated directly from the company. The funds raised from the IPO will now be available to Innovatech Incorporated to finance its expansion plans and develop new products. Secondary market, secondary investors, secondary market, primary investors. In the secondary market, primary investors who initially purchased the financial instruments from the primary market can choose to sell them to other investors. These primary investors may decide to sell for various reasons, such as realizing profits, adjusting their investment portfolios, or responding to changing economic conditions. Secondary investors. Secondary investors are individuals or institutions who buy financial instruments from the primary investors in the secondary market. These investors do not have a direct relationship with the corporation issuing the securities. Instead, they trade existing securities with each other based on market demand and supply. Importance of the secondary market. The secondary market is crucial for several reasons. Liquidity. By providing a platform for buying and selling existing securities, the secondary market ensures that investors can convert their investments into cash quickly. This liquidity is vital as it enhances investor confidence, making primary market investments more attractive. Price discovery. The secondary market plays a significant role in determining the prices of financial instruments. Prices are influenced by the supply and demand dynamics of the secondary market, providing valuable information on the perceived value of a company's securities. Investment flexibility. Secondary investors can easily enter or exit positions, allowing them to adjust their investment portfolios to respond to changing market conditions or personal financial goals. Capital recycling. The secondary market allows primary investors to sell their holdings and reinvest the proceeds into new opportunities, contributing to the efficient allocation of capital. Importance. Economic indicators. Example to support the keynotes. Continuing with the example of Innovatech Incorporated, after the successful IPO in the primary market, its shares are now listed and traded in the secondary market. Primary investors who bought shares during the IPO may decide to sell their holdings if they believe the share price has increased significantly, allowing them to realize profits. Secondary investors, such as individual traders or institutional investors, can now buy these shares from the primary investors in the secondary market. The secondary market allows these investors to participate in the potential growth of Innovatech Incorporated and become shareholders without the need to directly interact with the company. Additionally, the secondary market provides liquidity to both primary and secondary investors, as they can easily buy or sell shares at prevailing market prices. In conclusion, the primary market serves as a platform for corporations to raise capital by issuing financial instruments, while the secondary market facilitates the trading of existing securities among investors. Both markets are essential for companies to grow and investors to find opportunities to invest and manage their financial assets. The primary and secondary markets together form a robust financial ecosystem, promoting economic growth and efficient allocation of capital. Financial Market Environment Acts and Rules. These are laws and regulations implemented by governments and regulatory bodies to oversee and govern the functioning of financial markets. They are designed to ensure fair practices, stability, and investor protection. Maintaining a healthy financial system. A healthy financial system is crucial for the overall economy's stability and growth. It provides a reliable platform for businesses to raise capital, individuals to save and invest, and facilitates efficient allocation of resources. Regulations trigger specific behavior. Financial regulations are crafted to encourage certain behaviors and discourage others. For instance, regulations may be put in place to promote transparency, reduce risks, prevent market manipulation, and protect consumers. Importance of financial market regulations. A. Investor protection. Regulations aim to protect investors from fraud, scams, and unethical practices. By enforcing rules on disclosure, fair dealing, and transparency, investors can make more informed decisions, boosting their confidence in the market. B. Stability and systemic risk. Regulations help mitigate systemic risks and prevent financial crises. By imposing capital requirements and risk management standards on financial institutions, authorities can reduce the likelihood of market-wide failures. See fair competition. Regulations promote fair competition by preventing market monopolies and ensuring a level playing field for all participants. This fosters innovation and efficiency in the financial industry. Market integrity. Rules against market manipulation, insider trading, and fraudulent activities maintain the integrity of financial markets. This instills trust among investors and encourages long-term participation. E-consumer protection. Regulations safeguard consumers from abusive practices, ensuring financial products are suitable for their needs and understanding. This prevents mis-selling and exploitative behavior. Example: the Dodd-Frank Wall Street Reform and Consumer Protection Act USA. The Dodd-Frank Act, passed in response to the 2008 financial crisis, is an example of comprehensive financial market regulation. It addressed various aspects of the financial system to improve stability and protect consumers. Systemic risk oversight. Systemic risk oversight. The Act created the Financial Stability Oversight Council, FSOC, to identify and address risks posed by large financial institutions and prevent potential system-wide failures. Consumer Financial Protection Bureau, CFPB. Dodd-Frank established the CFPB, an agency dedicated to protecting consumers from unfair and deceptive practices in financial products and services. Volcker Rule. This rule prohibits banks from engaging in certain types of speculative trading with their own funds, reducing the risks associated with proprietary trading. Implementing measures. Derivatives regulation. The Act introduced regulations for the derivatives market, aiming to increase transparency and reduce risk by mandating central clearing and reporting of derivative transactions. Mortgage reforms. Dodd-Frank implemented rules to improve mortgage lending practices, including enhanced underwriting standards, banning certain risky mortgage products, and requiring lenders to verify borrowers' ability to repay. By implementing these measures, the Dodd-Frank Act aimed to create a more transparent, stable, and consumer-friendly financial system. However, it's worth noting that financial regulations should strike a balance between stability and innovation, as excessive or poorly designed regulations could stifle economic growth and innovation. Decision process. Investment decision process. Investors follow a systematic process to evaluate whether they should invest in a company or not. This process involves gathering information, analyzing data, and making an informed decision based on various factors. Importance of decision process. Making investment decisions based on a structured process helps investors minimize risks, maximize potential returns, and align their investments with their financial goals and risk tolerance. Investment decision process steps. Step 1. Research and analysis. Investors conduct research on the company's financial health, market position, and growth prospects. They examine the company's revenue, profitability, debt levels, and competitive advantages. Step 2. Industry and market assessment. Investors assess the industry and market conditions in which the company operates. They consider factors like market trends, competition, regulatory environment, and potential risks. Step 3. Financial ratios and performance metrics. Investors use financial ratios and performance metrics to evaluate the company's efficiency, profitability, and overall financial health. Common ratios include the price-to-earnings ratio P/E, debt-to-equity ratio, and return on equity ROE. Step 4. Management and governance investors examine the company's management team's track record, experience, and decision-making abilities. Effective leadership and transparent governance are crucial for long-term success. Step 5. Risk assessment investors identify and assess various risks associated with the company and its industry. These may include operational risks, market risks, and regulatory risks. Step 6. Valuation investors determine the company's intrinsic value based on its financial performance and future growth potential. This helps them decide whether the current stock price offers a favorable investment opportunity. Step 7. Diversification investors consider diversification by spreading their investments across different companies and industries. Diversification helps reduce the impact of individual company or sector-specific risks on their overall portfolio. Step 8. Decision-making based on the gathered information and analysis. Investors make a decision to either invest in the company's stock or look for other investment opportunities. Importance of investment decision process. Minimizing risk. A structured decision process helps investors identify potential risks and take steps to minimize them. By understanding the risks involved, investors can make more informed choices and avoid unnecessary losses. Maximizing returns. Thorough research and analysis enable investors to identify companies with strong growth potential and invest in them at an opportune time. This can lead to higher returns on investment. See aligning with goals. The decision process helps investors align their investments with their financial goals, such as saving for retirement, funding education, or purchasing a property. Example: investment in technology company. Suppose an investor is considering investing in a technology company. The investor starts by researching the company's financial statements, analyzing its revenue growth over the past few years, and evaluating its profit margins compared to industry peers. Additionally, the investor assesses the industry's outlook, considering factors like technological advancements, market demand, and potential competition. They review the company's management team, looking for experienced leaders with a proven track record in the technology sector. Well-informed choices. Next, the investor examines various risk factors, such as cybersecurity threats, regulatory changes, and market competition. Based on the company's financial performance and growth prospects, the investor calculates its fair value and compares it to the current stock price. Finally, the investor weighs the investment opportunity against their overall portfolio strategy and risk tolerance. If the company's stock price appears undervalued and aligns with the investor's risk appetite, they may decide to invest in the company. By following a structured investment decision process, the investor can make a well-informed choice, increasing the likelihood of a successful investment outcome. Avoiding financial crisis. Investment decision process. Investors follow a structured process to evaluate whether they should invest in a company. This involves conducting research, analyzing financial data, and assessing various factors to make informed investment decisions. Avoiding financial crisis. Investors consider the potential risks associated with their investments to avoid contributing to or being negatively affected by another financial crisis. Prudent decision-making and risk assessment are essential to prevent excessive market volatility and instability. Importance: investment decision process steps, with a focus on avoiding financial crisis. Step 1. Research and analysis. Investors thoroughly research the company they are considering for investment. They examine its financial statements, business model, market position, and competitive advantage to gain a comprehensive understanding of the company's strengths and weaknesses. Step 2. Risk assessment. Investors pay particular attention to assessing risks associated with the company and its industry. They identify potential vulnerabilities that could lead to financial distress or bankruptcy. By understanding these risks, they can make more cautious investment choices. Step 3. Financial health and stability. Investors analyze the company's financial health, including its debt levels, liquidity, and ability to generate cash flows. A financially stable company is less likely to face a sudden crisis that could impact the broader market. Importance: economic indicators. Step 4. Industry and market conditions. Investors evaluate the industry and market conditions in which the company operates. They look for signs of potential overheating, excessive speculation, or systemic risks that could trigger a crisis. Step 5. Stress testing. Some investors conduct stress tests on their investment portfolios to simulate how they would perform under adverse market conditions. This helps identify potential vulnerabilities and adjust their investments accordingly. Step 6. Diversification. Investors diversify their portfolios by spreading their investments across different assets, industries, and geographies. Diversification can help mitigate the impact of a financial crisis affecting a specific sector or region. Step 7. Monitoring and adjusting. Investors continuously monitor their investments and stay informed about changes in the market environment. If they observe signs of increasing risks or a potential crisis, they may adjust their portfolio allocations accordingly. Importance of avoiding financial crisis in investment decisions. A capital preservation. By being cautious about potential risks and avoiding companies with high levels of debt or unstable financials, investors can protect their capital from severe losses during a financial crisis. B. Systemic stability. Prudent investment decisions contribute to overall market stability by reducing the likelihood of large-scale market disruptions caused by unsustainable practices or speculative bubbles. See long-term planning. Avoiding risky investments and potential crisis scenarios enables investors to focus on long-term financial goals, such as retirement planning or funding future projects. Example: financial crisis of 2008. During the financial crisis of 2008, many investors suffered significant losses due to exposure to risky assets, particularly mortgage-backed securities with subprime loans. These investments were highly susceptible to default, leading to a cascade of financial failures. Investors who followed a structured decision-making process and were cautious about investing in complex financial instruments were better positioned to avoid the worst impacts of the crisis. Those who assessed risks, diversified their portfolios, and monitored market conditions were able to preserve their capital to a greater extent. Furthermore, the crisis underscored the importance of regulations and risk management in financial markets. Investors learned valuable lessons about the potential consequences of excessive risk-taking and the importance of being mindful of potential systemic risks. As a result, regulators and market participants have since implemented measures to enhance transparency, risk assessment, and investor protection in an effort to prevent future crises. Securities Act of 1933. Securities Act of 1933. The Securities Act of 1933 was enacted to ensure that investors receive accurate and transparent information about securities being offered for public sale. The primary goal is to protect investors from fraudulent practices and misrepresentation. Under this act, companies must register their securities with the Securities and Exchange Commission (SEC) and provide relevant information to potential investors through a prospectus. Importance: this act is crucial because it helps investors make informed decisions based on reliable information. By having access to the required disclosures, investors can better assess the risks and potential returns associated with an investment, allowing for more informed choices. Example: if a company plans to issue new shares to raise capital from the public, it must file a registration statement with the SEC, including detailed information about its financial health, business model, risks, and other essential data. Potential investors can access this information in the prospectus before deciding whether to invest in the company. Securities Exchange Act of 1934. The Securities Exchange Act of 1934 established the SEC as the primary regulatory body responsible for overseeing and regulating securities exchanges, broker-dealers, and other participants in the secondary market. It aims to foster fair and efficient markets, promote transparency, and protect investors from fraudulent activities. Importance. This act is critical as it ensures the integrity of the secondary market, where investors buy and sell securities from each other. By maintaining fair and transparent market practices, investors can have confidence in the market's functioning and are more likely to participate. Example: the SEC monitors stock exchanges to ensure that they operate in a fair and orderly manner. It investigates potential market manipulations and insider trading, taking enforcement actions when necessary to maintain market integrity. Sarbanes-Oxley Act of 2002. Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act was passed in response to accounting scandals like Enron and WorldCom, aiming to improve the accuracy and reliability of corporate financial disclosures. It holds corporate management accountable for the accuracy of financial statements and internal controls. Importance. This act is essential for investors because it enhances corporate governance and financial reporting. By requiring management to certify financial statements' accuracy, investors can have more trust in the reliability of a company's financial information. Example: if a company's CEO and CFO have to personally certify the accuracy of the financial statements, they are more likely to implement robust internal controls and financial reporting processes. This reduces the likelihood of fraudulent activities and increases investors' confidence in the company. Insider Trading Act of 1988. Insider Trading Act of 1988. The Insider Trading Act of 1988 prohibits individuals with access to non-public information from trading securities based on that information. It aims to prevent unfair advantages and ensures a level playing field for all investors. Importance. This act is crucial as it protects investors' interests and maintains market integrity. Insider trading can distort market prices and harm individual investors who do not have access to privileged information. Example: suppose a company executive knows that their company is about to announce a significant loss in its financial results. If they trade their company's stock based on this non-public information before the announcement, it would be considered insider trading. This act imposes severe penalties for such practices, deterring individuals from engaging in insider trading and protecting investors' trust in the fairness of the market.